Welcome. Today, we're jumping straight into one of the most critical moments in finance, what really happens when a loan covenant is breached. We're going to look at how control can flip from the borrower to the lender, sometimes in a heartbeat.
And this quote right here, it just nails it. A covenant breach isn't just about the numbers on a page. It's about the lightning-fast, high-stakes chain reaction that follows. You know, how a borrower handles this exact moment can literally decide the future of their business. So the key is understanding the game before you're even forced to play.
Okay, let's get into our first big point. I think the single biggest mistake anyone can make is seeing a breach as just some legal paperwork issue. It's not. It's the starting gun for a very, very serious negotiation.
So what are we actually talking about here? Well, a covenant breach is basically when a borrower doesn't meet specific rules in their loan agreement. These are usually financial things, like your debt can't go over a certain amount, or you have to maintain a certain level of cash flow. Think of it like a tripwire that's built right into the loan. And this is where you have to understand the modern lender's mindset. For them, a breach isn't really a problem. It's an opportunity. It gives them the legal right to completely reevaluate the deal, to reprice the risk they're taking, and to assert way more control over the business. The second that breach happens, believe me, the old rules are out the window. Which brings us to the next absolutely critical phase, because that period right after a breach, that's where this whole battle is either won or lost. Those first 3 days, they set the power dynamic for everything that follows. So what's the first thing that happens? You can expect a flood of information requests from your lender. And I mean a flood. They're going to want granular detail on everything. Financials, operations, you name it. And they're not just looking at the numbers. They're trying to figure out one crucial thing. Is this just a temporary blip, or is this a sign of a much deeper, structural problem with the business itself?
And this timeline just shows you the insane urgency. While the borrower is still processing what just happened, the lender is already in motion. In that first 24 hours, their risk committees are meeting, they're running financial models, they are building a strategy. So by the time they even call the borrower, they already have a game plan. Any delay from the borrower's side just makes their position weaker and hands even more power to the creditor.
So the borrower's main goal is usually to get something called a waiver. Now that might sound like forgiveness, but let me be clear. It is not. A waiver always comes at a price, and that price is designed to benefit the lender. This repricing of risk usually happens in 4 ways. First, you can expect higher interest rates and a bunch of new fees just for the waiver itself. Then, they'll add even tougher covenants, which basically tightens the leash on your business. And finally, they'll demand way more reporting, giving them a real-time window into everything you do. Each step isn't just about money, it's another layer of control that they are adding. Now, the borrower does have one big card to play, and it's called cure rights. This is a short, pre-agreed window of time to fix the problem, usually by injecting new cash or making some quick operational changes. But the clock is ticking. This is not an open-ended offer. It's a rapidly closing window. And if you fail to cure the breach in time, you're heading straight for disaster. And that brings us to maybe the most critical distinction in this whole thing. The difference between a simple breach and what's called an event of default. Because that is the point of no return. This slide lays it out perfectly. A covenant breach, that opens a negotiation. There's still a path forward. But when a lender declares an event of default, the negotiation is over, period. You're now officially in the enforcement stage, where the lender can use all of their contractual rights to get their money back, no questions asked. And the consequences are, frankly, catastrophic. Lenders can use acceleration rights, which means they can demand the entire loan be paid back right now. They can use enforcement rights to start seizing assets. But the most dangerous one is the cross-default risk. See, a default on this one loan can trigger default clauses in all your other loans, creating this terrifying domino effect that can collapse a company in days. So, knowing what the stakes are, how do you manage this crisis and start to win back some control? Well, it takes a clear, proactive playbook. First things first, you have to understand exactly what you've lost. This table shows it pretty starkly. Before a breach, the borrower is independent. You control your strategy, your spending, your financing. After a breach, every single one of those decisions is now subject to the lender's approval. Your freedom to operate is just gone. So here's the playbook for taking back some of that control. Number 1, engage early and be transparent. Hiding is the absolute worst thing you can do. 2, understand what motivates your lender.
It's not personal, it's just about their risk management. 3. Be prepared for that repricing. Model what those higher costs are going to do to your business. And finally, and this is the most important one, you have to control the narrative. Don't just show up with bad news, show up with a clear, credible plan for the future.
Ultimately, we need to reframe this whole event. In today's market, a covenant breach isn't necessarily a sign of failure. It's a strategic inflection point. It's a moment that, if you handle it with speed and preparation, can actually reset the terms and define the path forward for your company.
And that leaves us with the final question. It's not really a matter of if a business will face this kind of financial pressure, but when. And when that moment comes, the outcome will be decided by one thing. Will you be the one controlling the narrative, or will you let the narrative control you?